And through this journey, I think we had the pleasure of hosting a webinar with Taxsutra virtually every year. Um, and through the years, we have seen number of finance bills being introduced. Just this morning, if somebody would have asked me that would you get a finance bill 2024 whose contents will run into 114 pages, I would have taken any bet that no, there cannot be so many changes. And yet we saw all of it. But before we go to the finance bill, uh, a few salient provisions of the union budget itself. A very important thing, a fiscal deficit being kept in check, and the projected fiscal deficit for the year being under 5% at 4.9%. Very, very welcome. Just shows that FRBM targets are being met and exceeded, something which is very, very welcome. I was reading the other day Ruchi Sharma's book on what has gone wrong with capitalism. And he mentioned about how government going overboard and spending and controlling everything has led to it. And I'm glad to see that while so many foreign governments have gone berserk with their deficit, India has been able to keep deficit under control. Another aspect, I recollect just before the budget, I was on CNBC and we were talking about what were the industry's expectations from the budget. And a few things stood out. First was what is the government going to do on job creation? Very important, very critical. That's where India seems to be lagging behind at this point of time. And the government came back with a number of thoughts on job creation, including an internship scheme in collaboration with the industry. Let us see how that scheme rolls out, but should be something very innovative, very, very interesting. Or for that matter, skilling. And the amount of effort that is going into skilling is amazing again. The growth projections, the GDP growth projections are of the order of 6.5%, which was given yesterday in the economic survey. And I thought that very, very conservative, the government can actually achieve a lot more. And here was the finance minister reeling out a number of schemes, talking about a number of things. But more important, coming back to say that she is laying down a 5-year roadmap of what are the changes that should come about. Arun mentioned about a complete overhaul of the Income Tax Act, and I do not know in what form and shape will this happen. But what the finance minister said is that I would like the income tax provisions to become simpler, reader-friendly, easy to implement, promote ease of doing business. And she said that there were 3 aspects of the tax laws which she was dealing with in this budget. That was relating to charities, provisions relating to withholding tax provisions, and provisions related to capital gains. And we saw the changes again in abundant measure. And what she did mention is that over a period of next 6 months, she's going to look at complete overhaul of the Income Tax Act. That means that the next budget, which is about 7 months away, is again going to see a slew of changes to the Income Tax Act. Whether we'll see a new Income Tax Act or we'll see several amendments to the Income Tax Act remains to be seen. Yet another important aspect of this budget, I remember going and meeting up with the revenue secretary as a part of the FICCI delegation. And one of the things we very strenuously agitated was that the withholding tax provisions are becoming very tedious, the TDS provisions. And holding taxes, one is merely acting as an agent of the government. It is not your own tax. You're collecting tax from somebody to somebody's account for the benefit of the government. And A, you should not be left to the vagaries of having to deal with multiple rates. And B, you should not have to interpret the rates as to, and then be subjected to penalty as to whether you ought to deduct tax at 10% or 2% or 5%. And we requested for a rationalization. And again, rationalization has happened in abundant measure as we go ahead. The provisions related to capital gains again have got a lot of attention, a lot of spoken about because the stock markets reacted and then recouped the additional 2.5% tax on long-term capital gains on listed securities was something which was not probably contemplated, and therefore it came as a shock to the market participants. But that said, there are several other changes, whether it is short-term capital gains tax going from 15 to 20, or the tax on unlisted securities held by non-residents, etc., etc. And while at one level, one can go on talking about whether the taxes have increased or decreased, I think the real thrust should be on the rationalization. Because when we again went to meet with the Revenue Secretary, we said capital gains tax regime is very, very complicated. You need a whole table. What is the rate applicable to resident? What is applicable to non-resident? When does something become long-term? When does another thing become long-term, etc., etc.? Please rationalize. And as they say, be careful what you wish for. Obviously, when all that rationalization happens, there are some people who will be adversely impacted, many who will be positively impacted. But overall, can I come back and say today that the capital gains regime is very, very simple compared to in the past? The answer is yes. And as we go ahead and Umesh takes you to the direct tax provisions, you will see why I say this. The abolition of angel tax, the abolition of equalization levy, again shows that government is determined to take full steps, not half-hearted steps. We have seen in the past tinkering with the angel tax provisions, extending jurisdictions from which if investment happens, they will not be touched, etc., etc. And the government was repeatedly being told that what are you trying to do here? Why are you becoming a barrier to taxes on startups? And government finally took a step of biting the bullet and saying, we will abolish angel tax or the abolition of 2% equalization levy. Steps which are all in the right direction. More important are the steps on rationalization of reopening provisions, which gives a better certainty to assessments which are completed. So lots to talk about, and Arun is right when he mentioned that these are the provisions which, while we go through today, will continue to be gone through in fine-tooth comb, and then you will keep on analyzing them. And by the time you finish analyzing, will come the next budget and another round of changes, which is going to keep all tax professionals very, very busy. We have two of my partners who are going to take us today on the provisions. We have Umesh Kala, one of our senior partners, who's going to talk about the changes that have been made in the finance bill in the field of direct taxes. And then we have Ranjit Mahatani, who's going to deal with provisions relating to indirect taxes. As Myers mentioned earlier on, I'm sure you will have questions which you will want to post to us. Please feel free to put them in a chat box and we'll try and see and answer them as much as we can. So with that, if I can request Umesh to come in, and Umesh, the floor is all yours. And if you can take us through the provisions related to direct taxes. Thank you.
Very good evening. Myers, Arun, Dinesh, Kamat they are, and ma'am has delivered. A lot of guesses, surprises, what will come, what will not come, all laid to rest in terms of what ma'am has delivered, seventh record-breaking budget. But I think it's packed a lot of things for us to cover. And without much ado, we will plunge into the key provisions. And as Dinesh has mentioned, that there are wholesome changes, almost close to 100 budget proposals, and we will run through the major provisions. I think the first provision, which has raised a lot of agony, a lot of consternation, has been changes with regard to capital gains. And I think, as Dinesh has put, that capital gains was a complex regime. There were enough and more guesses in terms of a need for rationalization. We'll quickly go through what are the major changes. I think so. 3-4 key aspects. One is that period of holding. Today we had a regime where 12 months, 24 months, 36 months. So 3 periods were there. Now it's been rationalized to 2 periods. Listed securities, including units, we have a 12-month period for long-term capital gains, and for all other assets, it is 24 months. So very simple, 2 blocks, more than 12 months, more than 24 months, you are long-term, rest is short-term. As far as the rates on long-term capital gains are concerned, again, there was a disparity in terms of the rates applicable to residents and rates applicable to non-residents, all of that has also been put on an even keel, and therefore, by and large, most of the provisions, as far as residents and non-residents are concerned, they will go through a similar rate of tax. Now, what has been done is that for all long-term assets, including listed, unlisted shares, real estate, gold, practically all financial, non-financial assets where the transfers happen after July 23, 2024. The rate for long-term capital gains is 12.5%. A very major provision that we have to keep in mind is that indexation benefits are not available. And the benefit for non-resident in respect of Indian shares and debentures, where the existing computation provisions provide for a forex-based capital gains to be worked out, those provisions are retained. There's a small amendment, 1 lakh basic exemption limit is now increased to 1.25 lakhs. For ST, short-term capital gains on STT paid equity shares, equity-oriented mutual funds, the tax rate has been increased from 15 to 20%. And a major change that has been introduced is with regard to extension of short-term capital gains for unlisted bonds and debentures. Most of the bonds and debentures, typically, most people would not make a lot of gains. But if you see, a lot of the FDI investments in India happens through compulsorily convertible debentures. And for such compulsorily convertible debentures, unless you are covered by treaty, and therefore treaty applicability will become into focus. If you are covered under the domestic regime, any gain on CCD could be short term, and this could create a lot of flutter. All of these provisions, as I said, applicable from July. So transfers made on and after July 23-24. A small change which is very important, that there is an exemption for any gift made. A gift made by a corporate or for a partnership firm or an LLP earlier was exempt. Now it has been clarified that only individuals and HUFs are eligible for this benefit. A small clarification with regard to OFS, offer for sale. Lot of IPOs happening, lot of OFS being done, where there were views whether these OFS is taxable. Those doubts have been laid to rest. Again, government has time and again said that no retrospective amendments, but as far as this clarification is concerned, the government believes that OFS were taxable right from the beginning, and therefore these provisions are applicable retrospectively. So as I see, this is one major retrospective amendment. If you see generally the budget provisions, there are multiple dates, and therefore I'll want to give a statutory warning that most of the provisions that we will discuss, the provisions become applicable from AY 25-26 unless stated, and therefore please check the dates before we try and implement any of the provisions. A major change as far as buyback of shares is concerned. We've seen that the current regime for buyback of shares is that the company which undertakes the buyback pays a tax under 115 QA. Now the recipient, which is the shareholder, will be liable for tax. So the definition of dividend has been amended, and the recipient pays tax. But what is more surprising is that most of the existing dividend provisions, they talk of accumulated profits. Here, the entire sale proceeds become taxable in the hands of the shareholders. And there is a clarification that if I have paid 100 rupees as cost of the shares, I receive whatever money, that entire amount gets taxable as dividend. But I will be eligible for a capital loss short term or long term. The problem which is going to face most of the investors is that the dividends will be taxable as per normal regular slab. The capital loss, we all know that capital losses are not eligible for set off against other income, and therefore they will be eligible for set off only against capital gains. So you will genuinely have a mismatch where the entire buyback proceeds will become taxable. The buyback provisions become applicable from October 1, 2024, and therefore there is still some window which the government has kept open. If we are able to close the buybacks before October 1, then the new regime kicks in. after October 24. As far as business income is concerned, a small clarification that they have introduced is that if you are a developer and if you have unsold residential property, then there were a few decisions which said that the annual deemed income on those residential properties could have been taxable as income from house properties. Many developers took a view that we will convert or we will treat this as stock in trade. Now they have clarified that if you are treating this unsold residential properties as stock in trade, you will not be able to offer the actual rent or deemed rent as business income. A small amendment which could impact a large number of pharma companies is where they have provided that if there are any litigations with regard to potential violations, and if there is a payment whether in India or outside India for settling out of court all those litigations, then any amount paid will not be deductible. But an important point to be noted is that they're going to specify the laws under which the penalty was initiated, and therefore we will have to wait for a subsequent amendment in terms of which laws are getting covered. A small positive amendment for partnership firms where there is an increase in the remuneration payable to working partners. Current limits is there in the table. 3 lakhs is now increased to 6 lakhs, and therefore this is a positive amendment. The other amendment which Dinesh spoke of is that India is the third largest economy for startups. Most of the startups have done a lot of share issues, and there are enough and more horror stories in terms of how the angel tax provisions have really hit hard many of these companies. Fortunately, the government has paid heed to multiple representations from various. I think there is not a year gone where multiple chambers have represented. They have listened, they have amended, and by angel tax is completely abolished. There are existing provisions for confirmation of the source and the source of funds, and those provisions should take care of any illegitimate money which is getting routed through premium on shares. As far as foreign companies are concerned, the rate on foreign companies has been reduced from 40 to 35%. As far as the equalization levy is concerned, the equalization levy, so we have two slabs of equalization levy. One is 2% and 6%. The 2% levy, which was on online services, those e-commerce supply services, that has been abolished. There was a feeling that this will get continued till the Pillar 2 provisions come on the statute, but I think the government has seen that irrespective of whether the Pillar 2 provisions become applicable, they have abolished this levy. The other levy, which is on online advertisement services, where the tax rate is 6%, those continue. A small provision to encourage India as a tourist destination. So foreign companies who are operating domestic cruise ship services, there is a presumptive tax of 20%. And a small change with regard to penalty for liaison offices. Last year, we saw an amendment with regard to market-linked debentures, where market-linked debentures and certain securities they were taxed as short-term capital gains. We have some amendment to clarify that fund of funds, the investment criteria for such market-linked debentures has been modified. So it's now going to be 35% of the total proceeds, and therefore fund of funds will get covered under the provisions of market-linked debentures, and therefore the gains will be taxable as short-term capital gains. Again, another provision where the market was guessing that there could be some change, and this change has come. If you see the economic survey, there is a mention that a lot of youngsters are resorting to futures and options and derivative transactions, and therefore possibly as a measure to augment the revenue and to create a little bit of disincentive. The STT rates have been increased. So sale of a option in securities, the old rate was 0.0625, which has now been increased to 0.1. And as far as futures are concerned, it was 0.125, which has now been raised to 0.02%. As far as IFSC is concerned, I think this is one provision. India has a historical monument, which is like a heritage Taj Mahal, which we all know has taken 20 years to build. And if you see the IFSC provisions, year after year, there is incremental changes which keeps on happening as far as IFSC provisions are concerned. And every year, you will see some changes being done. The entire regime is still not fully in place. If we see the level of approvals, I think there is a little bit of gap in terms of what the government wants to do versus what it is actually able to do. As far as the IFSC provisions are concerned, a few will quickly run through. So there is a exemption for identified income which is currently available to specified funds, which is now extended to retail schemes and exchange traded funds. Income tax provisions have provisions for thin capitalization. IFSC entities will not be liable for thin capitalization provisions, and therefore this is a positive change for IFSC entities. And with regard to the share premium, where I mentioned a while back that the existing provisions require that any person who's receiving any money towards shares will have to explain the source and the source of source. There was an exemption available for venture capital funds. That exemption is now extended to venture capital funds also set up in the IFSC. As far as transfer pricing provisions are concerned, again, some concession for units in IFSC, where there is a relaxation provided. Another provision where transfer pricing officer can now examine domestic transactions. So earlier, if there is a reference made to a transfer pricing officer and he comes across transactions, then he could suo moto even cover international transactions in his transfer pricing assessment. Now, the transfer pricing officer will be able to even cover domestic transactions irrespective of whether these have been referred to him or not. Two other provisions with regard to transfer pricing which are material. One is that the government has made an announcement to say that safe harbor rules. Safe harbor rules are rules where if you offer income at a particular rate of tax, then there will be no transfer pricing assessment. Once you offer income at a particular level, then no transfer pricing adjustments are possible. The government wants to expand the scope and make it more attractive. And there are no specific budget provisions with regard to the safe harbor rules. One will have to see subsequently what are the provisions. Similarly, there is an announcement that the transfer pricing assessment procedure will get streamlined. Again, as I said, nothing in the budget proposal, so we'll have to wait for subsequent changes which the government comes about. An important demand of the industry, which I think Dinesh made a reference that TDS has become very tedious. There is the tax assessees are subject to TDS provisions. They have to deduct tax, pay within a particular time, file a return, issue a certificate. There is a whole lot of things that the taxpayers are supposed to do, and the rates that were specified, those rates actually envisage that a lot of working capital gets blocked, and therefore the government, there were demands by multiple chambers of commerce to rationalize the TDS rates, and the TDS rates have been rationalized. So by and large, wherever the 5% rate which was specified, if you can see in the table, those have been all reduced to a 2% rate. As far as e-commerce operators are concerned, the existing TDS rate was 1%, which has now been slashed to 0.1%. There is a very important provision which is with regard to sale of luxury goods, where there is a TCS provisions currently applicable with regard to sale of motor vehicle, where the sale proceeds are more than 10 lakhs. So if the seller is selling a motor vehicle, then he will collect TCS. Now the government has proposed to expand this to different categories of goods, and again, nothing specified in the budget proposals, but this should possibly cover other luxury items, uh, given that the affluence in the Indian economy is at a high level, and there is still a lot of unaccounted money which gets invested in some of the luxury goods which people use. Therefore, this provision is trying to collect a small tax, but more than the tax, the government wants to keep a tab on the people who are spending money towards such purchases. There has been some rationalization with regard to TDS and TCS provisions. We will quickly run through. I think these are all procedural changes. The interest for delay, as far as TDS, which is currently at 1.5% per month, is now extended to TCS, and therefore the rate is for TCS delay also the rate is now 1.5% per month. A very important provision which has been bothering a lot of assessees, that if there is a delay and default with regard to payment of TDS, the government is trying to increase the number of prosecution cases, and once there is a delay, by and large, a lot of people had received prosecution notices. Now the government has clarified that no prosecution for failure to deposit TDS if it is paid within the due date of filing of the quarterly returns. So if you missed out at the time of actual transaction, you will get time till the due date of filing of quarterly returns. One would believe that this should get extended to the entire year, so that if people by any innocuous default, if they have missed out on payment of TDS or TCS, then they should, once rectified, they should be able to rectify, no prosecution should get initiated. There is a uniform time limit which has now been provided for TDS default. Earlier for residents, this was 6 years. Now both for resident and non-residents, a uniform period of 6 years has been provided. I will not labor on the other TDS TCS provisions. Charitable trust, if you see the last few years, quite a few Supreme Court decisions which have put charitable trust into some amount of disarray. And what we currently have is two regimes. One is the 1023C regime, and the other is a Section 11 regime. So we had two parallel regime, and if you see the 1023C regime, it had one provisions and almost like 20 provisos, and reading the 1023C provisions has become quite a nightmare, because there is a proviso after proviso after proviso, almost 18-20 provisos. What the government has proposed to do is that they have proposed to unify this into a single scheme for charitable institutions, which will be the default scheme will be section 11. Those who have already filed applications for exemption under 1023C till 30th of September, those applications will be processed, and there is a 5-year period for, so till if they get an approval under 1023C, till the time that the approval is valid, they will be governed by 1023C regime. Once the approval gets over, then they will migrate to section 11 provisions. So one scheme for charitable institutions, which should be good. But I think as far as charitable institutions are concerned, there are still a lot of complications, especially basis the two Supreme Court decisions in the case of Noble Education and ODA. We've not seen amendments with regard to some of the provisions which have been tinkered or which have been analyzed by the Supreme Court. So let's wait for the amendments which the government is trying to carry out over the next 6 months, and hope that the charitable regime is simplified. But there's one other positive change, that merger of approved charitable institutions will not be liable for any exit tax. So what happens is that if there is an existing charity which gets merged with another charity, upon the existing charity merging with the new charity, if the charity ceases to be a charity, then there is an exit tax which was applicable. That exit tax is applicable on the entire fair market value of the assets. This created a huge roadblock. This is a positive budget proposal, and I think charitable institutions will like this provision. So we could look at some consolidation across the charity sector. We come to the personal tax, nothing major. The government, if the finance minister had while delivering the budget speech, said that almost two-thirds of the people have migrated to the new regime. So they are trying to ensure that the new regime becomes more and more lucrative. So there is a little bit of slab rate changes. So existing 6 lakh slab from 3 to 6 lakhs was 5%, is now extended to 7 lakhs. And similarly, the next slab also, which was 10% till 9 lakhs, is extended to 10 lakhs. Total benefit 15,000, not much. But a major thing which the entire salaried class would want to cheer is that the standard deduction has been increased from 50,000 to 75,000. As far as the NPS is concerned, again, this is the desire of the government, that India does not have a robust pension scheme, and therefore the government wants to encourage more and more people to invest in the national pension scheme. So the existing limit of 10% deduction both for the employer and the employee. So as far as employer is concerned, if the employer pays up to 10%, has now been increased to 14%. And similar Chapter 6A deduction has now been extended to the employee with regard to contribution in the national pension scheme. As far as personal tax is concerned, there was an expectation that there will be some relief extended as far as interest on housing loans is concerned. But given the buoyancy in taxes, one would have hoped that government could have done some changes to the interest on income from house property. But maybe that's been parked for a future date. As far as we move to the next important change, which is with regard to reassessment. What we saw over the last 3 years, that the reassessment provisions were overhauled in 2021. So we had a new regime of reassessment where two basic slabs, 3 years and 10 years, was the regime, and there was a grandfathering which was applicable for all assessments which were prior to the new regime coming into effect. Now we have seen a further rationalization where the basic 3-year limit continues, but the next limit, which was up to 10 years, is now reduced to 5 years. If you see in the table, there is the existing provisions, 3 years is extended to 3 years and 3 months. So the 3 years and 3 months is basically to deal with the procedure as far as initiation of the reassessment notice under what we call Section 148A. So there is a 3-month provided for the tax officer to send a notice, get a reply from the SSC, and deal with the final order. And therefore, the overall time limit is 3 years, 3 months, and 5 years and 3 months. As far as information is concerned, there is a small clarification which is self-explanatory. The assessment provisions, the time limit for completion of assessment provisions has been rationalized. If the return is furnished after CBDT has condoned a delay, and if the SSC has filed an application under Section 119, and if that delay has been condoned, then once the SSC files the return within 12 months, the assessment has to be completed. Wherever the SSC files appeal before Commissioner of Income Tax Appeals, in many cases the Commissioner Appeals would set aside or would remand the assessment for some factual finding by the assessing officer. There was no time limit specified. Now, fortunately, there is a time limit of 12 months which has been specified. But I think the major grouse of the tax-paying community is that today there is a huge pile up as far as CIT appeals are concerned. I think there is nothing in terms of mention in the budget speech or in terms of an actual budget proposal to deal with the huge pendency of appeals before the commissioner appeals. Again, a major change which would impact a lot of assessees is that the block assessment for search cases has been reintroduced. Again, as far as the search cases are concerned, there has been multiple regimes that we have gone through. There was a normal regime, there was a block regime, there was so in 2021 when the reassessment provisions were modified, all the existing search regime under section 153A was disbanded, and all search cases were supposed to be covered under the new reassessment regime. If you look at the existing search regime which was there before this reassessment regime came with effect from 1st April 21, there each of the search years were subject to a separate assessment. Now what we see is that the entire search cases will be covered as one block. So if there is a search which is initiated after September 1, 2024, then it will be covered under the new regime, which is the block assessment for search cases. The block period is going to be 6 years. And a very interesting point which is there is that if the search happens in a current previous year, then from the 1st of April till not the date of the search, but till the date of the last search authorization, that could be a broken period. It could be 6 months, it could be 8 months, 9 months. That will be part of the block. As far as block assessments are concerned, whatever is the undisclosed income, that undisclosed income will be taxable at a flat rate of 60%. If we see the fine print, whatever is disclosed for which the return is filed or for which the assessments are already completed, those will be not liable for the 60% rate, but is in respect of a return filed where the assessment is not complete and we migrate into the block regime. And during the course of the block assessment, if there is an addition on that entire addition, the 60% flat rate will be applicable. There is a clarification in the budget proposals that currently there is no surcharge under 234 ABC. Maybe at a future point in time, they might want to bring in interest. And if there is any shortfall as regards the undisclosed income, so if the return for undisclosed income is filed at 100 and the final assessment is done at 200, on that incremental 100, there is a penalty provisions of 50%. So 60% tax and 50% penalty on that is 90%. Typically, when you have the TDS regime, you collect, you deduct 10% and retain 90%. As far as search is concerned, government believes that they will retain 90% and you will retain the balance 10%. I think the previous speakers did mention about Vivad Se Vishwas scheme. I think if you see, one of the major ills that is plaguing our tax regime is the amount of litigation that is there. Multiple years, the government realizes that the level of litigation has been very high, and therefore we have seen such type of schemes introduced in the past as well. This year also the government proposes to bring in Vivad Se Vishwas scheme 2024. But when we look at the provisions, and we will spend some time going through the provisions, I think what worries us is that possibly the government is trying to cure the symptoms, but the root of the problem is still not addressed, and that is the reason why we have huge amount of litigation. I think the number of appeals that the taxpayers file, the number of appeals that department files, if you see the success ratio of the department in terms of winning is less than 10%. And therefore, the department being the major litigant, I think there is a need for bringing in little more accountability ensuring that there are parallel dispute resolution provisions. But again, this is for some other day. We will go through the key highlights of the Vivad Se Vishwas scheme. As I said that this is introduced to reduce pending litigation. The past Vivad Se Vishwas scheme didn't have a fabulous success, but there were still a lot of cases which were resolved. Hopefully, I think there'll be a continuation of the scheme. By and large, it's the same die which has been used by the government. So all pending litigation as on July 22, 2024 will be eligible for the new VSV scheme. The December 31st is the first due date for payment. Again, the breakup in terms of whether the entire tax has to be paid by 31st of December is not yet clear. There is the scheme provides option to the SSC to discharge the disputed tax, interest or penalty. And therefore, if you are in appeal or if the department is in appeal against the SSC and the appeal covers a disputed tax, then it can get covered under VSV. If the appeal is with regard to interest or penalty, even those could get covered under the VSV scheme. There are a few cutoff dates which are very important to understand. So the government believes that they have two cutoff dates. One is 31st of January 2020. So all appeals which are filed prior to 31st of March, 31st of January 2020, the tax rate applicable is 110% of the disputed tax. So the government wants to, for matters which are pending for long, they have looked at 110%, and for appeals which are post 31st of January 2020, the applicable rate is 100%. So if you pay before 31st of December 2024, then 100% and 110%. And if the tax is paid on or after 1st of January before a due date, the last date has not been clarified by the government, then the applicable slab as per the table is 110% or 120%. Where there are tax arrears in respect of interest or penalty, then 25% of the disputed interest or penalty could get covered. And again, the table shows that if it is paid before 31st of December 24, then 25%, and if it is paid after 1st of January 25, then 30%. Again, I think the table is self-explanatory that you have 2 periods in terms of pending appeals, 2 periods for payment of tax, and one will have to see which is the year and which is the date of payment of the tax, and therefore the table becomes very self-explanatory. If the SSC wants to opt for the VSV scheme in respect of an appeal which has been filed by the department, then the same table becomes applicable. The only correction is that whatever is the tax rate which has been specified in the table gets reduced to half. As far as prosecution and allied laws are concerned, again, very quickly we'll deal with some situations. So there is a decriminalization with regard to TDS default. As I mentioned earlier in my talk, that TDS defaults where there is an innocuous default or delay, then penalty and prosecution notices were being faced by the taxpayers. So now there is a provision to say that if the TDS is paid before the time limit for filing the quarterly TDS statements, then in such cases there will be no prosecution which will be initiated. It's a very welcome change by the government. As far as black money is concerned, again this is a provision which has been introduced to deal with undisclosed foreign assets. But the way the provision currently is, it impacts a lot of taxpayers. So if I am an employee with an Indian company or an employee of a foreign MNC with a subsidiary in India, and if I am given employee stock options of the foreign multinational, in some cases there could be innocuous defaults in terms of not declaring such foreign assets. Currently, as per the provisions, even if there is a default in non-disclosure of a foreign bank account or a foreign asset, and if that's covering even 100 rupees, there is a 10 lakh rupees penalty which is payable. The government has clarified now, a provision has been introduced to say that if it is non-disclosure of a foreign asset other than immovable property, and if it does not exceed 20 lakhs, then there will be no penalty. The other provisions with regard to earning foreign income or foreign assets which are not disclosed with the income tax authorities in India, those provisions continue. As far as Benami law is concerned, and I think the government has a lot of focus on the Benami law. There were amendments which were introduced. Part of those amendments were struck down by the Supreme Court. But as far as the budget proposals are concerned, there is an immunity from penalty and prosecution to a Benamidar. So if Mr. A is the real owner of the income or the asset, and Mr. B is the Benamidar, if the Benamidar or the one who has abetted the Benami transaction, if they own up, then they will be covered by the immunity from penalty and prosecution. But the person who actually owns the income, the real owner, he is not covered under the immunity from penalty and prosecution. So with this, we have by and large looked at all the key provisions of the direct tax. The budget proposals were introduced by around 12:30, and in the next 3-4 hours to crunch the major amendments which were there. We've tried to cover most of the provisions. If there are any questions, and if there is time, we will deal with those questions. Arun, is that fine?
Yes, we'll take the questions at the end. There are many questions. We'll take some of them.
Okay. With this, I will hand over the proceedings to my partner, Ranjeev. Sorry. Okay.
So we had Vivad Se Vishwas 2.0 for income tax. There was quite an expectation as we went into this budget that there would be some sort of an amnesty for dispute resolution litigation on the customs side. Unfortunately, that's not the case. However, there are certain other developments proposals which are quite encouraging in the most. So the first one is the proof of origin that needs to be provided under a free trade agreement, a regional trade agreement. Now there is a ability to provide a certificate or a declaration, a self-declaration, as is prescribed or as is specified under the relevant trade agreement. There was some amount of confusion. There was some amount of disputes that were occurring on the ground as benefit of concession was availed under these trade agreements. One development which I don't think comes as a surprise is that the mover regulations, which is the manufacturing and other operations in warehouse regulations, is going to be somewhat curtailed. The scope of it, the coverage of it is going to be somewhat curtailed. The proposal is for provisions which will enable the government to specify certain manufacturing processes and other operations which may be carried out in relation to a class of goods that shall not be permitted in the warehouse. So the mover regulations of 2019 effectively provided a mechanism for duty deferment and to sort of cater to the export market. Now, in respect of certain sector, which was the electricity, the electrical energy sector, setting up of a solar setup and providing electricity from a mover regulated operations was something that was done by the industry, was not taken well by the government. It was considered as not being eligible, and that dispute sort of went into the court, where the court considered the facts and said that this is within the scheme and the permitted sort of contours of the scheme, and therefore allowed that sort of operations to continue. And here we are with the proposal where the government will now have the power to restrict certain processes as not being eligible for the mover regulations and the benefit. Another issue which forms part of the proposal is also something that has gone through court, where the compensation cess was held not to be exempt in the context of imports by the SEZ unit or developers for their authorized operations. There is an Andhra Pradesh High Court decision on the subject, which said that the compensation cess is not covered, and therefore the exemption could not be enjoyed. The amendment or the proposal here is in fact, I think, as the intention always was, that supplies to a SEZ for, or whether it's a unit or developer, for all purposes is exempt, including for compensation cess. Certain trade facilitation measures which have been proposed, the time limit to re-export aircraft and vessels which are imported for repair, so in the MRO activities, has been increased from 6 months to 1 year. At the same time, the period for duty-free re-import for goods under warranty, which would be for replacement, has been increased from 3 to 5 years, with the ability to even extend it further. There have been certain rationalization of the custom duty rates, which are essentially directed and to augment the domestic manufacturing, to create jobs, and to promote, clean and green energy. And some of the, notable ones are reduction having been made in respect of critical minerals, cellular mobile phone, where production has really improved over the last few years. There has been an increase for the same reasons in the context of plastics, chemicals, printed circuit board assemblies of certain telecom equipment. As we look at now the GST proposals, the 53rd GST Council meeting made a plethora of recommendations, and we find most of them sort of covered here with the legal changes, with the law changes, and we will talk about some of the key ones now. The first one is that extra neutral alcohol, or rectified spirit, which is used for the manufacture of portable alcoholic liquor, is going to be kept outside of the purview of GST. This also has been a subject matter of disputes pending in court at this point as well. As we know, portable alcohol is not subjected to GST, and therefore the chain was, sort of suffering that extra burden. And with this proposal, it will take care of that problem. A new section is proposed which will regularize a non-levy, a short levy of GST, where the tax was being short paid or not paid due to common trade practices. Now, this is an important proposal for several reasons. One is the erstwhile law, whether it was central excise, whether it's the customs law, whether it was the service tax law, they all contained a provision of equivalent kind. Where the government had the ability to take cognizance of certain practices and condone them. Now, the formal sort of provision for that now has been inserted even in the GST law. That's one. Second, this will immediately be of interest for the online gaming sector, amongst others, where the government then can come up with some sort of provisions to look at the past period where there is a dispute which is ongoing, and that as well is in the Supreme Court at this point, and they could look at sort of settling the entire dispute in a manner which is a win-win for both sides. And there would be the need to use the Section 11A provision. A amendment which concerns the ability to pay the reverse charge tax and then take the credit has been somewhat overhauled. And for imports where it's for supplies which are from registered taxpayers domestically, that is, the timeline runs at 60 days from the date of that invoice, that the self-invoice has to be created. For others, which would include an import of service, that timeline is to be prescribed. With that, then the sort of timeline to take input tax credit will run. A beneficial sort of proposal, and which was also in the recommendations of the 53rd Council, is that for the period of 2017-18 to 2021, in respect of any invoice or debit note, there can be filed. The return can be filed up to the period of 30th November 2021, and thereby the input tax credit can be taken and enjoyed. This is a very useful one for the industry. A lot of the disputes in the initial period concerns input tax credit, whether it's a mismatch, whether it's a non-availability in the 2A ledger, whether it's a registration cancellation, and several such other sort of problems. This provision will, make it much easier. Will enable people to, heave a sigh of relief that this is sort of, put to rest, especially in the initial years of the GST. An important amendment which has been proposed is that the availability of input tax credit for the tax that has been paid pursuant to or consequent to a Section 74 proceeding was previously restricted. 74, of course, deals with cases of fraud, suppression, willful misstatement. Now, there was a provision which existed in the erstwhile excise law as well, where the credit, if paid on the back of fraud, etc., was not allowed. That was continued into the GST regime. Now, with the overhaul of the provisions, the proposal is to do away with this restriction, and this is a good move that has been proposed, because it will encourage the sort of taking of credit, and therefore the chain or the cascading effect will not be felt. The government has also proposed to restrict the refund of unutilized credit or refund of integrated tax, which has been paid on account of zero-rated supply of goods where it is subjected to export duty. Now, this is a sort of restriction so that there is no beneficiation on both sides, essentially. The other sort of set of provisions and proposals, and these are quite important from the overall perspective. The first one on the slide is concerning the ability to have an authorized representative appear and represent, make statements, depose, produce documents and evidences before the proper officer who is conducting the proceedings. When somebody in an organization or a registered taxpayers organization has been summoned. There has been quite a bit of proceedings that have been going on. Summons are quite often resorted to by the tax department. Here now it's being clarified that when a particular designation or a person has been summoned, it's not necessary that only that person or that designation, that officer is himself present or herself present. There is an ability to authorize and have that authorized representative instead appear and make the necessary proceedings go further. The other provisions which are concerning the sections of 73 and 74, where there was some amount of chaos, there was some amount of confusion because of these two large sections with several subsections, which became bone of contention in many cases. So the proposal, the recommendation that was made at the 53rd Council is to collapse the two sections which deal with the raising of demands, the recovery of tax, and the proceedings in respect of that, to be housed in one particular section in 74A. And here we now have Section 74A, which essentially retains the contours that were there in 73, in 74, except for the key change, which is the timelines that have been prescribed. So the timelines, as you will see, in some context goes up, as in there's an increased timeline available to the tax department, and in some context it will in fact reduce. So in the original 73, a show cause notice could be issued 33 months from the filing of the annual return or the due date for the filing of the annual return, whereas the order had to be then passed within 3 months of that date, which is 36 months. On the other hand, in 74, which deals with cases of fraud, suppression, and misstatement, the timeline to issue the show cause notice was 54 months, and the order then needed to be passed within 6 months, which is 60 months, therefore 5 years. Now, in 74A, the timeline for the issuance of the show cause notice is 42 months from the filing of the annual return or its due date for filing of that annual return. And the order has to be passed within 54 months. So it's, just short of 5 years, with it being able to be extended by the permission or by the approval of the higher authorities in the tax department by 6 months to 60 months, so 5 years. So as you'll see in the context of Section 73, the timelines have now been increased, whereas in the context of 74, they are essentially somewhat curtailed. Now, these are the changes which have been made on 73, 74 by introduction of 74A. But the other sort of aspects as regard the process, the penalty, etc., are kept as is. They are now housed in 74A is the only difference. The recommendation also from the GST Council during their last meeting, the 53rd meeting, was the reduction in pre-deposit for the amount that needs to be paid as and when preferring a statutory appeal. Now the amendment is like this. At the first appellate authority, the existing requirement was to pay 10% of the tax where tax interest penalty was demanded, which is retained at 10%. However, the monetary amount has been reduced from 25 crores to 20 crores. So in aggregate, at the SGST, CGST level, you would pay 25 plus 25, which was 50 crores previously. Going forward, it would become 40 crores as 20 plus 20. At the appellate tribunal level, previously there was a requirement to pay 20% further, which would have taken the totality payment to 30%. That's now been retained at 10% further. So that takes you to 20% in all. And the fiscal amount or the monetary amount has been reduced and kept at the same level as at the first appellate authority. So previously 50 and 50, 100 crores was the total outer limit that could have been paid as pre-deposit. Now that will be capped at 40 crores. So therefore, the total burden, the pre-deposit burden that the registered taxpayer may feel has gone down from 30% to 20%. The timeline, of course, as we discuss all of this, we still all await the tribunal to be set up to sort of come into running. The timeline for filing of the appeal is going to be 3 months from a date that will be prescribed. We have, of course, in the simultaneous, a circular that has been issued, which requires taxpayers to pay up their pre-deposit amounts and prefer a letter or an undertaking that they are interested and inclined to file an appeal against their order that has been passed. So those are the sort of process or procedural actions that need to be taken by potential litigants. The next sort of issues that we have to talk about is the amnesty related provisions, which are contained in section 128A, which is something that we were all sort of looking forward to, the fine print on it. And the proposal is of course now housed in 128A, what will be 128A of the CGST Act. It of course extends only to section 73 proceedings, and it applies to the financial years of 2017-18 to 2019-20. A question that has arisen is that in the initial phase of GST, why could this not have been taken further down up to 22-23 at least, and thereby give a clean chit to the past period litigation that is otherwise brewing. The waiver, of course, is for all of the interest and penalty where the tax amount is paid. The date is going to be specified during the recommendation that the council made after its meeting. The date indicated was 31st March 2025. We believe that should be the date. However, it is not specified in the finance bill that has been tabled today. Now, one sort of issue that also does come up where tax has been paid and it was all sort of closed out, but the show cause notice has been issued in respect of interest only. Then, in such a case, would this particular situation or position be covered by this proposed scheme in Section 128A? Is something that's not very clear, and we'll have to sort of await some clarifications on that front. As was expected on anti-profiteering, the sort of sunset clause has been introduced a tad late, but nevertheless, it's now here. And from a date to be notified, no new applications for anti-profiteering situations would be entertained by the government. For certain sort of issues that had arisen, there were representations made by the insurance sector. And in that context, the clarifications have been issued, and now it takes the form of a sort of amendment to Schedule 3. Schedule 3 deals with situations which do not qualify as a supply of goods or services, i.e. not taxable. And the first one is the sort of sharing that occurs between a leader and a follower in the insurance sector, where the leader has paid the entirety of the premium to GST and offered it to GST, and then sort of shares the portion with the co-insurer or what is called the follower in the sort of pre-agreed ratio. That will not be a situation of supply, as has been clarified and now brought in through to the Schedule 3. In the similar fashion, ceding commission that is paid between insurer reinsurer will also not qualify as being a transaction for supply, and so that would not also be subjected to GST. So these are the key sort of proposals that have come through in the finance bill today. And we will now look to discuss some of the questions and comments that Arun would also like to share.
Thanks, Ranjit. Before we get into the questions, two provisions which I couldn't cover, I'll very, very quickly deal with. One was with regard to TDS on interest and remuneration paid by a partnership firm to a partner, which is now subject to TDS. And therefore, this is a major change. So the TDS is applicable at the time of credit or payment, whichever is earlier. The other provision which I would, which is part of the budget speech, where possibly this will be followed up by an administrative amendment, where we covered that in order to reduce litigation, the government wants that the department, currently there are limits in terms of filing of appeal by department with regard to tax amount. The existing limits as far as ITR is concerned, which was 50 lakhs, is now increased to 60 lakhs. For appeal by the department to a high court, if the tax dispute is currently at less than 1 crore, then the department can't file an appeal. Now that 1 crore has been increased to 2 crores. And as far as an appeal before the Supreme Court is concerned, the existing limit of 2 crore is increased to 5 crores. Over to you, Arun, for covering.
Yeah. Umesh bhai and Ranjit, many thanks for the wonderful presentation. I almost thought we'll be here for 3 hours. I'm sure that only y'all can condense such a heavy budget in barely 75 minutes. So we have some time for questions. I have 52 questions. We'll take a few. The biggest question or the oft repeated question here is on buyback. Umesh bhai, you want to just explain? The memorandum actually has given an example on the buyback. So a lot of questions on buyback taxation. You want to just take 2 minutes to explain how it will work?
Yeah, so I think while we very briefly covered, the buyback taxation in the earlier talk, but I think we will deal with a few nuances. So the first thing is that, as I clarified, that the definition of dividend has been amended to include the entire buyback proceeds, and the entire buyback proceeds will now be treated as dividend, irrespective of whether the buyback is in respect of accumulated profits. So even if the company which is undertaking the buyback doesn't have accumulated profits, whatever is the absolute amount of buyback proceeds which are received by the shareholder, they will be liable for tax in the hands of shareholder as dividend. There are no expenses which are deductible in the hands of shareholders. So once this dividend is taxable, gets taxed at as per the applicable slab. Uh, Section 46A, which is a provision which is there for taxation of buyback proceeds. There is a clarification to say that sale proceeds in respect of such a buyback which is liable for tax as dividend, that sale proceeds will be treated as nil. And moment the sale proceeds is treated as nil, the entire cost is available as a cost, and therefore the entire cost will give rise to a loss. It will be short term or long term depending upon the period of holding. Very interesting nuances, which again, for paucity of time, we will not cover, but I'll just touch upon that with regard to those people who are covered by double tax avoidance agreements, whether the modification of definition of dividend would apply as far as treaty situations are concerned. And
that's one of the questions.
Yeah, so I think there's no standard answer. One will have to look at the relevant treaty provisions. Normally, one would feel that dividend definition and any modification in the definition of dividend will should be only concerning the domestic tax law and should not apply to double tax avoidance agreements. But some treaties have a reference that dividend as treated under domestic law. So one will have to look at those provisions, and then basis a fine reading of the double tax avoidance agreements, we'll have to take a view. But I think there is some work left for the advisors to chip in.
Yeah. Next one, Umesh.
Also one other aspect, I think the cutoff date has been 1st October, and they are saying when the buyback is done. Now, what is the date when the buyback is done? Whether the date which is announced when the company receives the offer,
yeah,
or when the company accepts the offer, or when the company pays the proceeds in the hands of the shareholder, or finally when the share certificates are destroyed. Again, this is left for people to discover. Generally, my feeling would be that it will be the date of payment.
Sure. Hopefully, no company will leave it so late. One question from Sanjay Kapadia: the proposed provision reducing time for reassessment 5 years from 10 years comes into effect from 1st September. Therefore, department does it have time till then to go back and reopen up to 10 years?
I would believe yes, because this is a prospective date, and therefore the department, if it wants to hurry up and issue a flurry of reassessment notices, one would expect that something like this should not happen. But I think every person would try and maximize whatever he can, and therefore if the department maximizes what they can do, it should not be taken as a surprise.
A lot of questions on capital gains, no surprise here. One is from Utkarsh. He asks, as regards the capital gains on property, is there any fair value concept left, or is it over?
Yeah, so I think the fair value concept has not been discarded, but I think the major benefit of the fair value. So fair value as on 1st of April 2001 still remains intact. If the government modifies the date, so we had earlier 1481 as the fair value date, which has now been increased to 14/2001, and if the government modifies it, that will be something prospective later on. But because the indexation has been done away with, so if the transfer, whether it is of shares of an unlisted company or a immovable property, if the transfer happens on or after 23rd July, which is the day today, then you have the new rates kicking in, the new period which is kicking in for immovable property. The old period was also 24 months. The new period is also 24 months. The rate reduces from 20% to 12.5%. But on the other hand, on the flip side, the indexation provisions are completely done away with. Therefore, you have FMB as on 1/4/2001, which is available, but no indexation.
Yeah, this is again on buyback, but a little conceptual. This is from Ms. Daksha Bakshi. She asks, writing a few lines on what's happened. Would treating such gross payment as ordinary income not go against the principle of characterization of income for tax?
I mean, if we see the fine print, what they have done is that they've modified the definition of dividend, and parallelly they have also provided that capital gains will be consideration will be treated as nil. Um, there is also an amendment in the definition of income, and because of all of these three things, this now becomes like a deemed income, and therefore taxable as dividend. Capital loss available, but that capital loss is subject to a carry forward period of 8 years. If you don't have capital gains, then you will not be able to set off the capital loss, and therefore I think it could create in specific situations a lot of angst.
So covered from all sides, almost all bases covered. No room for maneuvering, possibly. One more. Any thoughts on proposed 194T? Will it be attracted as and when partner withdraws?
What they have said is that the TDS is applicable on payment or credit, whichever is earlier. If you are taking a view that the partner has capital and he withdraws, I mean, periodically the partner will withdraw for his household expenses, for a lot of payments for utilities where the payments are directly made from the partner's capital account. If these are adjusted against the opening capital, then this may not be treated as a payment of remuneration or interest, and therefore, as and when the remuneration and interest is credited, usually those credits will be when the books of accounts are closed, and therefore the at the time of the withdrawal of funds, if we are able to take a view that the withdrawal is against the capital balance, then no TDS will be applicable. It will be only at the stage of credit. That will all depend upon the facts. If we are taking a view that whatever are the withdrawals are from opening capital balance, then while calculating the interest on the partner's capital balance, you will have to factor in the reducing balance on account of withdrawals. So today you had a lot of situations where people were calculating the full interest on the opening capital balance plus all further capital infusions, and taking a view that all the withdrawals are against the current income and interest and remuneration. So you'll have to do either of these two approaches. If you want to take a view that the partner is withdrawing against the interest and remuneration, then TDS will have to be done at the time of each payment, or TDS at the time of credit.
Yeah. And next one, indexation benefit on sale of long-term assets have been withdrawn. What would be the impact and the effective date of amendment?
I think the provisions don't leave any room of doubt. If the transfer of a capital asset has happened July 23 and subsequently, then no indexation provisions are applicable. If you see the provisions in terms of section 112 and section 48, I think this date is the date which is cast in stone, and therefore if the transfers have happened between 1st of April and July 22, then indexation benefits would be available subject to other provisions of law. But once the transfers have happened July 23 or later, then no indexation benefits are available.
Question from Rahul. What about existing litigation on angel tax, as the amendment doing away with it is effective from April 1, 2025?
I think it's a plea that assessors and their advisors would like to take, but I believe that this is not a clarificatory amendment, but there are a few decisions of the Supreme Court which have said that any provision, if it is introduced to remove a hardship, then it is to be considered as retrospective, and therefore we will have to rely on those set of decisions and maybe plow further to convince the appellate authorities to take a view that this is actually a provision, and there is enough literature available in terms of the yields of angel tax, and therefore at least the prima facie case is available that this is a provision to remove a hardship, and therefore those decisions will be available.
Ranjit, this one is for you. Comes from Ashok Jha. What will happen to appeals filed for order issued for ITC claim late? If we withdraw appeal as order becomes null and void, will we get refund of mandatory deposit?
So there is no refund which will be granted by the department, not under this amnesty scheme. So you have to withdraw the appeal as a matter of how the scheme will have to operate, and there is no refund. So the issue sort of abates after that.
A question actually which came up even on a TV panel that I was on, that Kailash asked the same question. Is there any change in section 54 and 54F in this budget?
Yeah, so I think this is a flip. I mean, so existing provisions on section 54, 54F remain as they are. Last year we saw a major amendment where the amount invested for a residential house under 54 and 54F was brought down to 10 crores. I think those limits remain. But when the earlier provisions of when the buyback tax was not applicable, and when shareholders and companies were resorting to buyback, what was being effectively done by the shareholders is that because this income was treated as capital gains, there was a possibility for the shareholder to avail the benefit of 54F. Now, because of the change that the buyback proceeds now become taxable as dividend, there is no capital gains which is applicable, and therefore no benefit of 54F that a shareholder will be able to avail. So government seems to have done its homework and done this smartly enough to ensure that people don't go back to the old ways.
Yeah, Umesh bhai, there are quite a few messages saying it's a wonderful presentation by you and Ranjit, and I am thanking them on your behalf. Dinesh bhai is here to round off the proceedings. We still have 5 minutes to go. 5 minutes of moderator's time. Dinesh bhai, I quite honestly, the real question is the finance minister straight up, and I thought that I should say this. I did say it on a TV channel as well. What was different about the budget? Nothing about 2047. No talk of Amrit Kal. Hardly any mention of Vikasit Bharat. Very little of Atmanirbhar. But if you still go back to some of the earlier budget speeches, the last two, I tried to compare. Some of the themes were the same. In terms of action, a lot more, but also seems to be, if we did not perceive a change in the reality, in the political reality 45 days back, we have seen it today. But to straight up come up on Parliament Part B and say that I am going to have an overhaul of the income tax code within 6 months, this is a question, Dinesh, I have put to you for the last few years on this very webinar. And we were not sure what will happen, but there was a sense, and I felt that that the Income Tax Act is getting really unwieldy. Maybe the government has come to the same conclusion.
I would agree with you. I think two things, if I go back to the sorry. So two things, if I could come back and what was happening in the finance minister's speech. One was the emphasis on Andhra Pradesh and Bihar was very much there. And that showed how coalition politics plays its role. And not at the end of the day, it's a part of the country being developed. But to have such a lot of emphasis on medical school, airport, roads, etc., temple, tourism in Bihar, Gaya.
And tackling the 800-pound gorilla in the room right up front, unemployment, right up front.
Correct. Yeah, so you're right. She began with unemployment, what is required to be done there. She then went straight to skilling, again tackling it right. So it was quite a business-oriented budget. It was, as they say, a boring budget, which is what budgets are supposed to be, which is what they are supposed to do. And I was just watching some of the computations which were done on this indexation and 12.5 versus 20%. And in quite some situations, 12.5 without indexation seems to be better than 20 with indexation. So it really depends on how prices have moved up, etc. But would we not agree, hand on heart, that this is a real simplification? You are doing away with residents, non-residents. You are doing away with multiple asset class, with multiple timelines, all of that, the multiple rates. So I think it's quite a step forward. And I think, again, going on to the VSV, and let's see where it goes to. But last time, Umesh mentioned that VSV was a reasonable success. I think it did manage to clean up quite a bit. I hope it does this time also, depending on how the scheme is rolled out. But I would overall very much welcome. And, like, again, going back on the angel tax and saying, just we're going to kill it. Let's not just get on with it.
But then the question is, Dinesh, what took it 10 years to kill?
See,
Why are we being reactive?
It's a question which one can always ask. Why was, see, you go back and Arun, say, why was the provision introduced? Because people felt that black money was being used to circulate. So it was first introduced. Then we said, okay, if it is overseas money, then we will not do it. Then we came back to say, okay, if it is venture capital, maybe we will not do it. I could actually come back and say that maybe the reason why it is being done now is that now we have got GAR in place. Okay? There is enough and more under GAR which one can attack any such circulation of money, tackle it upfront. So it's been done now. One should welcome that rather than say, why did it take 10 years?
Yeah, if we do go for the overall of the income tax code, Dinesh, the 2 or 3 things that you want to say. I know there are some 50 things we can discuss. Top of the mind that comes to you.
So one is really, I was a little bit surprised not to see anything on pillar 1, pillar 2 being in this, but and that's something which needs to happen. It's something which India has to fall in line with the global framework. Indian companies have got operations overseas, etc. So what happens in and around that? That's one thing which needs to happen. Again, lot of has already happened with regard to exemptions and deductions for corporates. I think we need to just move to that simple, and it's more about administrative convenience. So how do we ensure that if you applied for a certificate under 195, 197, it comes in good time? Those are the things, and I've always said the law.
Can I quote the Finance Ministry? It's a comprehensive review of Income Tax Act, where it is concise, lucid. I wrote it down. Easy to read, and easy to understand, and will lead to tax certainty. Probably Lord John James would want to be alive.
No, I understand. That certainty and taxation don't go hand in hand at all. But we can move towards, like, just look at this.
I just wanted to read the tea leaves, Dinesh. It clearly says that it just won't be about the proposal. I think it will be about how the language is worded. We could be looking at some serious relook at how the act is worded.
About reading the tea leaf. Look at what they have done to TDS. Complete come back to say just one rate virtually all across. All litigation now on interpretation on what is work, what is technical services, everything comes to an end, right? Suddenly you've got a rate which is far more rational, and you're coming back to say this is what you need to do going forward.
Yeah, true. Dinesh, in terms of where we are as a nation when it comes to tax administration, tax, I'm not talking about certainty, but purely tax administration and taxpayer services. It's a motherhood that gets repeated every budget, but yet people are not perceiving that the tax administration is as efficient as it should be. You have income tax collection which have gone through the roof from 1 lakh crore 21 years back or so to 18 lakh crore net, and personal income tax collections for the first or second time in 20 years exceeding corporate tax collections. Surely, there's a lot for government to be proud of in terms of the collections, but there's also the sense all income. I mean, across the board, if you ask corporates, taxpayers, that tax administration leaves a lot to be desired, and no amount of Income Tax Act amendments or fixing or making it simpler is going to make the administration more efficient than it should be. I think the last time we had this focus was Dr. Shom's report.
Yeah. And I again go back to the point I was making, Arun, that it's not that we need change of law. We need a change of mindset. Our law is created to fix issues of tax evaders. who may be a very small percentage, and every law is addressing them rather than addressing how do we deal with the honest taxpayer. So if I could be a little bit more direct, taxpayer service is a myth today. It'll take a lot of time for that to happen. There is no taxpayer service anywhere at all. You are running from pillar to post. I think it's a mental attitude change which is necessary, and which is what will make ease of doing business. There is no amount of tax law tinkering which can result in ease of doing business.
Then it will be very, and I wind up with this question. We always said, what's the big theme? What does it portend? And so on and so forth. Now, the big themes are all here. In that sense, you're also going to see a overhaul. But there is something here in the budget also try to give you a sense. I was on a panel with a few people, and off the record, they were all telling me, now the reality is dawning. We are seeing a lot more receptiveness with some of these proposals. You think that this is in that sense, in sense of the tonality of the budget, that this is a more receptive budget than saying that this is what you get, this is what you get, this is what we give.
And the answer is to be categorical yes. I was mentioning in an earlier interview, this budget I had 2 rounds with the revenue secretary, one as Dhruva and other as Fiki, and many of the proposals which you put, including this whole TDS thing, including that TCS should be set off against TDS, were the propositions. And when we are putting the propositions itself, we could see the body language, the receptivity. The revenue secretary come back and say, why not? And we are seeing the proposals being implemented.
From a Fiki point of view, and this is just a one-line answer, we've seen the collection grow from 6 lakh crore in the last 10 years to 18 lakh crore on the direct tax side. You think that directionally this will be the way the tax collections will grow?
Absolutely, and I think all that we need now is corporates to grow, more investments to happen. One of the things we never discussed, because there was a passing one sentence with the FM maid to say that she's going to relook at the entire FDI regime, okay? Make it simpler, etc., etc. I wouldn't be surprised if some of the thresholds in some of the larger sectors like insurance in due course are removed, etc. Things are made very, very simple and process oriented. I think that's where the country is going to grow. And if that's where capital formation will happen, and that's where extra profits will come in and collections will happen.
On that note, can we wind up the webinar? The final word always belongs to Dinesh, a stalwart in the tax world, founder, CEO of Dhruva Advisors. What a wonderful presentation we had from Umesh Bhai and Ranjit on the direct tax and indirect tax proposals. A lot of you here have asked for a copy of the presentation. With permission from Dhruva, we'll try to circulate, maybe even host it on the Taxsutra website later. Tonight, Myers, are you still there? You want to have a final word, or should I close the webinar? I think on behalf of Dhruva Advisors, International Tax Review and Taxsutra, many thanks for joining in. It was a packed house for the last 90 minutes. A lot of you even viewed this on YouTube. So if you want to have a recording, you can watch it on YouTube, on the Dhruva YouTube channel. Once again, on behalf of all of us, thank you. And yes, we will see you within the next 6 months for Union Budget 2025. A comprehensive overhaul of the Income Tax Act is what the Finance Minister is proposing, is hinting. Let's see what happens on February 1, 2025.
Thank you.
Yeah, thank you.
Thank you.